Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. My guest today is Alex Cathcart, Portfolio Manager at Drummond Capital Partners. Welcome, Alex.
Hi, morning.
So I thought, a great place to start with you, given your background in asset allocation and portfolio design, is to sort of talk about where we are in the market today, where there's some real questions around prices being disconnected from the economic reality. Firstly, what are your thoughts on sort of that backdrop?
We don't think they're necessarily disconnected. Like the market rally has obviously been exceptional. So was the sell-off, notwithstanding the correction last week. But we think there's a few things that explain the rally we've had. So the first one that matters probably the most is just the relaxation of lockdown across the world, starting from around late April. It should lead to a relatively sharp recovery in growth, so growth that will look like a V, and markets like growth, markets are forward-looking. So to the extent that earnings in 6 months' time, 12 months' time, 18 months' time are higher than they will likely be in the June quarter 2020, that's quite favourable for markets. Something else for us that makes a big difference is, I think, a capitulation in expectations for higher interest rates. So everyone's discounting assets based off risk-free rates. I can't imagine many people are thinking risk-free rates are going to rise meaningfully in the short to medium term and potentially not the long term either. That makes equities look more attractive on a relative basis. The other thing that's quite meaningful is liquidity provision from central banks and stimulus from governments around the world. This isn't the GFC. I don't think people think the financial system is going to implode here. This is an exogenous shock where demand was artificially suppressed by governments, rightfully so, to try and prevent the spread of COVID-19. To the extent the relaxation of those restrictions supported by liquidity provision, which prevents a systemic shock through the global economy, that's a relatively short-term thing, and you can see light at the end of the tunnel.
Mm-hmm. So let's maybe pick up on one particular point. You talked about sort of the liquidity provisions from the central bank, and it's not just the US, but globally, we're just seeing huge amounts of liquidity come into markets. How important is liquidity when you start to think about either your strategic asset allocation and sort of long-term expected returns for asset classes versus maybe even your TAA?
We think about it quite differently between the two. From a TAA perspective, I think if you got the Fed right post-GFC, you would have got asset allocation right through that period. And there's a lot of market commentators who complain that the whole economy is driven by Fed liquidity, and to some extent it is, and I think to a large extent it is. But that's the world we exist in, and you have to invest in the world you exist in, not the world that you think is morally right. So to the extent that liquidity provision has been exceptionally large, that's been positive for markets, and part of our TAA process is actually looking at whether the policy stance is favourable or not favourable, and we make active asset allocation decisions based on that. From a SAA perspective, it's a bit different. So we take a scenario, or this year we have taken a scenario-based approach to constructing our SAA, and we're thinking about how the current world plays out over a longer-term horizon. In that respect, we're talking about does the current coordinated monetary and fiscal stimulus morph into something resembling MMT or helicopter money, or some combination, some coordinated approach of the two, leading to potentially 7 years plus out, but still in our long-term investment horizon, some spike in inflation, which no portfolio is really constructed against at the moment. Or do we go the other way and follow Japan into deflation, or do we just have a repeat of the last 10 years, where you've just had very low interest rates, inflation below targets, but still reasonable earnings growth, which these equities outperform. So we think that it almost feels trinary, the way the world could play out. And so we're trying to construct our SAA to diversify against those three potential outcomes.
So let's talk about the SAA more specifically. How do you think about an SAA in terms of asset class? Is it a total portfolio approach? What are the characteristics that make up the SAA?
So it's a risk factor approach, which I guess you could also call a total portfolio approach, where we're thinking about what are the risks in the SAA. So you have obviously equity risk, duration risk, credit risk, etc. But we're trying to build the portfolio based on a foundation of uncertainty, which I guess it sounds bad, but what we're trying to do is build a portfolio that's robust to many outcomes. So we have obviously the scenario-based approach to constructing capital market assumptions, which is hopefully embedding robustness across that dimension. We also do a lot of stochastic modeling around portfolio returns, trying to look at how correlations might break or resolve to something differently, see what the final endpoint valuations of a portfolio are likely to be, of a dollar invested. Trying to look at how to trim drawdown risk. So there's a lot of trying to, if you're familiar with a fan chart, trying to narrow the fan chart and keep portfolio outcomes relatively tight and aligned to objectives.
Mm-hmm. And a lot of funds, particularly in the industry fund space, have sort of looked to infrastructure and some of the private assets as part of the way to sort of find assets that are quote unquote uncorrelated. What are your thoughts on that?
So we don't invest in illiquid assets just because of the way we invest, which is through managed account structures. I don't think there's anything not wrong necessarily with investing large chunks of the portfolio in illiquid assets. Certainly from a liability hedging perspective, infrastructure makes a lot of sense for a superannuation fund. Although I think there is, and it's probably become quite evident now, there's a lot of idiosyncratic risk embedded in a lot of these assets. So you're very comfortable holding an equities portfolio, say 50% of a growth option. It's invested across 3,000 securities at a relatively low weight in each. Suddenly you have an infrastructure portfolio that's 10 to 20 assets, 0.5% to 1% each. A quarter of that is airports. And suddenly you have this idiosyncratic risk up here, which is hard to quantify ex ante, but you don't have that issue when you're investing in a big pool of listed securities that are all sort of a lot more diversified, just purely because you have so many more of them in the portfolio than you do unlisted assets. So to the extent that they provide diversification, they do, because they're valued monthly or quarterly. But I think from an underlying risk perspective, I don't think that owning 4% of Melbourne Airport is different to owning 4% of Sydney Airport. It's just one looks like it has less volatility than the other.
Mm-hmm. Well, you can always get to the point where you have diversification that is actually making it worse, because you end up with the same exposures that are stuck there. So I want to go.
I was going to say, yeah, for sure. And there's obviously that's not even accounting for the illiquidity of these assets, which limits flexibility and asset allocation. So yeah.
Let's move to another piece to that puzzle as we think about an SAA or this total portfolio approach. A lot of funds are now starting to look at alternatives as another approach. Some parts of the alternative space hasn't done so well. Some of these CTA style products haven't done well. Do you guys use alternatives, and how do you use them?
We do use alternatives. We use them in the defensive and the growth side of the portfolio. The addition of them to the defensive side of the portfolio is a new sort of innovation as part of this SAA. There's a reason for that, and that's the bond yields are everywhere incredibly low. And we don't have as high conviction as we would have done 5-10 years ago. The bond yields can rally meaningfully in a significant equity market drawdown. And I think that's a mechanical reality unless the zero lower bound issue gets resolved with cash rates. which may happen. And if it does, we'll be prepared to probably add a lot more bonds to the portfolio. But the defensive side of the portfolio, we're just looking for things that diversify against equity risk, and also potentially inflation risk, because one of our scenarios is inflation. The sorts of assets we're looking at, the sorts of investments we're looking at in this space are things like CTAs, are things like very low volatility market neutral funds. But there is an issue of market structure potentially with some of these alternatives, and that's the last two corrections, bear markets that we've had, so December 18 and the most recent, probably happened too quickly for investment structures like CTAs to actually capture and benefit from the market drawdown. So we have to make a determination as to whether we think big drawdowns in the future will be protracted like the TNT bubble or the GFC, or more sort of 87 COVID style drawdowns. In the net choice we made is we basically think there's probably a reasonable chance of both. So that means there probably is a place in the portfolio for those sort of alternatives.
Mm-hmm. It's interesting you talk about market structure and fragility that's there. I'm curious on your thoughts, as a number of asset owners, not just from the small players, but to the large sort of pension funds and super funds that also get involved with a lot of systematic style modeling, and have specific risk targets. How much do you feel that sort of market fragility is based on the fact that everyone is using sort of the same sorts of types of modeling and sort of the same approaches to risk as well?
Yeah, I think it certainly matters. I doubt there'd be a DAA or TAA process in an institutional pension fund or sovereign wealth fund that doesn't have, say, multi-asset momentum as part of their process, potentially over a longer term valuations, or they don't make much of a difference over a shorter term. So the way people think about this, there's not that many sort of truly bespoke ways to do it. There's things that have worked historically in the past, and chances are they've been embedded into people's processes, and hence they're going to influence outcomes in the future. I think rather than the sovereign wealth pension fund sort of no leverage space, the bigger issue is potentially sort of vol-targeted funds that have a lot more notional exposure, and that dramatically reduce notional exposure when volatility spikes. Obviously, that leads to market liquidity crunches, and the absence of bank balance sheets to provide a buffer in that space is obviously less post GFC and the regulation that followed. There's potentially, you would think in that environment, there's a role for big funds to actually play a role as a provider of liquidity, and I think some are actually doing that. But in terms of market structure and liquidity, it certainly feels like there's a lot more crowding in terms of market sell-off.
Mm-hmm. Let's stick on this whole systematic approach, because a lot of funds use some sort of a systematic process that also flows into their investment process. How do you think about sort of the investment process, particularly from a governance standpoint? You want to make sure that it's robust and can be replicable, through time. But how do you also sort of look at that and understand that the market maybe is changing, the macroeconomic background, the regime is changing? How do you sort of map those two together?
I think so. For us, we have systematic elements to our process, and our process is systematic in the sense that we look at the same things. And it's systematic in the sense that parts of it are automated, so we don't have to spend time updating things. But it's not purely systematic in the sense that it's a set and forget black box model. So I think that the sweet spot for asset allocation is some incorporation of qualitative and quantitative aspects to the process. So there's going to be quantitative things that have worked well historically, and you cross your fingers and hope that they'll work well in the future. And there's qualitative aspects where you're trying to think about how the way the world is changing. Are we entering a new regime? What are the chances that the systematic or quantitative aspects aren't likely to work as well in the future as in the past? So I think that the combination of those two things is, for us anyway, the sweet spot there.
Would you also say that there's a bit of a judgment overlay that maybe sits on top of some of this modelling?
Yeah, so we have there's for us, there's a final judgment overlay in the team. So we have a TAA process, or we call it TAA. I don't see the large distinction between the two, but we have a TAA process that has a lot of quantitative inputs that produce effectively a score, which is sort of suggests where we should be allocated from a risk budgeting perspective. But there is a judgment at the end of that, and there's also qualitative aspects that go into that scorecard. But the final judgment makes a lot of sense, because you really want to consider like why the thing is actually telling you what it is telling you. So the judgment element looks at that and says, well, we know the inputs to this, so you should know the output based on sort of a heuristic assessment, and you want to make sure that it's consistent with what you're actually thinking. And 99% of the time it isn't. It is, and if it isn't, that leads you to do research and think about things in more detail. We also have quite robust investment committee process, where our investment committee are all sort of independent experts in investment, asset allocation, risk, etc., and they provide a good oversight and judgment overlay to our process as well. So although the decision making is delegated to the investment team, the investment committee are involved in the sense that they can ask us why we're doing things, make sure there's consistency between our process and our actions, etc.
Mm-hmm. Well, I know we talked a little bit about sort of the liquidity provisions from central banks, and the other piece that I guess is becoming more and more prominent is sort of this sentiment, particularly from retail traders that seem to be pushing markets. How do you sort of maybe take into consideration that sentiment that's out there, and thinking about the risks that also come alongside some of the movements that we've seen of late?
It's hard to distinguish the true extent to which retail has actually driven the rally. You look at, so there's positioning surveys that suggest that it was underbought by institutional investors, although they're always qualitative surveys, so it's hard to actually know what was going on. There's definitely some weird stuff happening in specific securities, so you can follow Robin Track and see where the Robinhood investors are throwing their money. But I don't know, like, I'm as concerned about them as I am about, Bridgewater or AQR de-risking a risk parity fund because bond volatility spikes. I think there's the point of it's good from the perspective of an asset allocator that there's other people out there doing things that aren't following the exact same investment process that you are. If the world was just purely long only passive, I think that the opportunity to add value through active asset allocation would be a lot less.
Mm-hmm. Well, that's actually an interesting transition, and we I think the next place to talk to is sort of this passive versus active style of approach. How do you think about it, and maybe where do you specifically maybe look for more active managers to play, and versus different parts of the portfolio where you just feel a passive exposure is appropriate?
We try and keep fees reasonable at the portfolio level. So to start, like straight away, that creates a fee budget that we have to allocate across the different areas. For us, most of that fee budget goes to global equities managers. So from our perspective, the managers that we've invested in have delivered more alpha than, say, like a bond, active bond manager has. So that's our preference. And then we're more passive on we're more passive on the bond side of the portfolio than in the credit side of the portfolio.
Mm-hmm. And are there particular sort of geographical regions that you look for as you start to sort of, I'm trying to think about from a top-down perspective as you look at these risk factors, how do you make sure that these risk factors are diversifying and also providing the returns that you expect?
So we're not. So diversification of risk, like say equity risk factors, isn't necessarily our starting point. We like growth managers and have since the fund started. So we have a lot more growth or anti-value, the value managers in the portfolio, which has obviously worked well recently. And that's one of those things you think about. Is there a structural change that means value is dead? AQR make a really good case that it isn't, and they're probably going to be right in the long term. But there's certainly a secular trend in the type of companies that end up in the growth bucket that doesn't really seem, absent some big regulatory shift, doesn't really seem likely to abate it anytime soon. So we're happy to have like certainly an anti-value tilt, and that leads to a US tilt in the portfolio in the equity asset class.
Mm-hmm. So the next thing, you sort of talked about sort of inflationary issues as potentially a problem. You've now mentioned regulation as another issue. What other sort of longer term thematics sort of maybe in the portfolio being thought about in terms of different scenarios, or will likely to come up going forward?
I think the big one is inflation versus deflation. That's a real, because that leads itself to changes in an SAA rather than tactical changes. But most portfolios, so 70-30, 60-40 portfolios set up and gained popularity once inflation was largely under control and declining for many years. So if we have a period of potentially not the inflation we saw in the 70s, but just a period of higher inflation, there's things that people don't tend to have in their portfolios, so commodities, gold, that would play a role if we thought that was the central case and would embed into the portfolio. And you probably have a lot less government bonds structurally in that world as well. So that's a big thematic that we spend a fair bit of time thinking of and try and build defense against effectively in the SAA design process. The other thematics, there's always things to worry about, and for thematics you're always thinking about things to worry about. China and US tensions is something that seems like it's now going to be embedded structurally for a very long time. So whether it's a new Cold War or not, it's probably too soon to say, but there's certainly bipartisan consensus within the US that China should be seen as a strategic adversary rather than a country which they can cooperate with. So history hasn't had a lot of great experience with two superpowers with diametrically opposed ideologies cooperating well together. So I think that's going to be interesting from an investments perspective, because the role of China within portfolios is probably dramatically underrepresented relative to the size of its economy. And through time, most funds, I think, are thinking about how do they access China, particularly in a more meaningful way. This strategic relationship between the two countries sort of makes you wonder, should that actually be the case, and should people think about having potentially less China exposure in their portfolios?
Mm-hmm. Oh, look, that's a question we will definitely not be able to answer today. Look, the China thing is very interesting, as people want to get exposure to the growth and the changing nature inside the country. One way that a number of funds have sort of tried to do that is the periphery through EM. What's your thoughts on maybe EM as an alternative?
So we have, like I'd say most other multi-asset funds, more EM than market cap, less EM than GDP weighting. It is a thematic that that seems like a really good idea. It's where the growth is. They're the only region with positive real interest rates, but they've failed to deliver returns for such a long time. So we have more than the market cap in the hope that they can actually start to generate investment outcomes, but we're conscious that that's a yet to be evidenced. And there's obviously like governance issues. So EM governance is problematic, is unlikely to be resolved anytime soon. Often the good news EM stories are when you have a strong leader emerge who sort of promises reform, but it's not institutional. It's not change in institutional governance. It's you have a Modi appear and suddenly India looks a lot better. And if Modi is not there, does India stay good? I don't know. So there's that's potentially a problem. You can also access EM through DM companies, which is obviously a strategy that's pretty well trodden, but the share of revenues going to the source from EM into large DM companies is grown a lot, and it's probably likely to continue to grow.
Mm-hmm. A related issue to EM, but again DM, is currency and currency exposure. I guess with central banks all around the world running their own little campaigns, and also governments with their fiscal policy, we're seeing volatility maybe suppressed to some degree in some of the financial markets, but we're seeing some quite large movements in currency. How does currency sort of play into the portfolio, not just from EM, but even from a DM perspective?
Yeah, we like, well, so from the perspective of an Australian dollar based investor, we have the great advantage of having a currency that, when you don't own it, is relatively diversifying against equity risk. So we have quite a bit of foreign currency structurally in the portfolio, and hopefully that provides some diversification in the future, even if bonds don't. EM currencies, interesting. Often you think if there is a positive reform story or a positive EM story, you could invest in the EM currency and not so much worry about the equity market. So we don't hedge our EM equities exposure. So we try to, I guess, get the benefit of the currency appreciation and the underlying market appreciation as well. So I think that's how we think about currency. We're also active with the currency as well. So as there's probably the biggest risk in the portfolio after equities, we have a process to sort of tilt in and out of foreign currency exposure.
Mm-hmm. Let's take it a little bit closer to home, and maybe some of your past career at both CBUS and Q Super. You've worked for a couple of industry funds. Now working for Drummond. How's the process different in terms of sort of building a portfolio where you are now versus your previous experience?
So there's a couple of differences that are mechanical. So one of which is because we invest via managed accounts, there's no derivatives in our portfolio, so we have to buy and sell with funds or ETFs or securities. So that's a little bit different. It means we have to be a bit more cautious when trading, because obviously the transaction costs are higher. There's difference in the sense that the problem is the same. So investment is about problem solving, and the problem we're trying to solve is the same problem as we're trying to solve at Q Super and CBUS. But there's probably less other things here. So it's quite a small team. We're a boutique. So there's not really any peripheral things going on. I'm not trying to say it in a pejorative sense, but I certainly have a lot less meetings now than I used to. So it's I guess a more streamlined investment process. I'd say that.
Does that allow, do you think, for much more sort of fluid decision making? Are you allowed to sort of have more investment committee decisions more frequently? How do you think? Yeah.
It's quite so. There was both at CBUS and Q Super. There's delegations were pushed down through the investments team, so you weren't necessarily reliant on an investment committee scheduled to make asset allocation decisions. But just by nature of having fewer people to talk to things about, things move quite a lot quicker than they do elsewhere, and that's probably to be expected. The governance around super funds are different to the governance in a fund manager.
Mm-hmm. Well, how would you also say that your portfolio would differ from, say, a traditional balanced fund portfolio that you would see at any industry super fund?
We carry, so our balance, we don't call it balance, but we'd say a balanced fund for us holds less equity risk than a super fund. So the way super funds work is you kind of think about what rating category you want to be in, and that's your sort of equity risk bounds. Because the end investors here are financial intermediaries, we are a little bit, let's say, cleaner about the way we think about net equity risk in the portfolio. So our growth equivalent of a growth portfolio has about 70% equity risk in it, which is probably at the low end of what the industry super fund world would have. Obviously not counting Q Super in that mix because they have a very different investment strategy. So that's probably a difference there.
Yeah, because one of the things that's interesting is that there has always been questions around sort of the the current structure of sort of a balanced or growth portfolio that's set there, and it doesn't move so much, but doesn't allow for this nimbleness to actually sort of make some more of these active returns because of their size and also because of the PDS that they've sort of put forward, and also peer risk is another problem.
Yeah, so we don't really have a peer risk problem, which is nice. We have ranges that we operate in from a DAA or TAA perspective. So we for the strategic series, which is what the equivalent of the industry funds and retail super funds would be, we're plus or minus 10% equity risk is effectively our bounds, and we actually use those ranges. So we were pretty close to maximum underweight equities through the COVID drawdown, and subsequently added back. So it's quite active in that sense. And we also have a goals-based portfolio, which sits separately to that. And that portfolio doesn't have an SAA, and it has incredibly wide ranges, so plus or minus 40% equity risk from a starting point of roughly 50 equities and bonds. So that portfolio is, as you would imagine, extremely active. It's been as high as sort of 80% equity risk and as low as 20% equity risk in the last 12 months.
Mm-hmm. Well, there's some very big numbers. I guess one of the next questions that sort of comes to my head is, how do you then communicate that to your members, and investors ultimately?
Yeah. So proactive communication is a big thing, and that's also one of the advantages of a managed account structure is the end investor has the beneficial ownership of the funds that we actually invest in. So they see the changes as we make them. Because of that, it's important for us to actually communicate what we're doing, and we do that. So we write monthly pieces about the market outlook and various related things. And every time we make a change, we communicate why that change is being made. So we're trying to as the financial intermediaries, so that the planning groups, family offices, etc., are the ones who are our immediate clients, and obviously their investors are our end clients. We're about empowering them to talk to their clients about the changes that are actually being made to their portfolios, and I think we do a pretty good job of that. And I think we do it in a way that is hopefully interesting for people to read as well.
Mm-hmm. So last question, and that's a tricky one at the same time, is we're coming up to a market that's still, there's still some concerns and volatility that sits behind it. A number of people are starting to re-engage with their funds, particularly their retirement options, and worried about sort of sequencing risk. How do you sort of maybe give people comfort to stay the course? When there is these volatility sort of spikes and the ability to sort of have enough money for their retirement effectively.
Yeah, I think the biggest thing there is probably trust. So for us, to the extent that the individuals invested in the structures trust their planners, and the planning groups trust us, that takes a lot of the heat out of that. So I think trust and clarity of communication is probably the biggest help in that space. I think there's also there's a communication challenge around longevity and sequencing risk. I think a lot of the work the industry funds have done has shown that most people die with assets. So rather than so that the issue is not so much that they run out; it's that they have too much left. So that there's that challenge as well. You need to actually get the retirees enjoying their retirement and spending their money rather than worrying that they're not going to have enough.
Mm-hmm. All right, that's been a fantastic conversation. Thank you very much for your time today, Alex.
Thanks a lot, Alex.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Conexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.